Hey, what's up guys? Welcome back to the channel. My name is Frank Mularcik, and in this video, we're going to be talking about ETFs and mutual funds, how they are similar and how they are different, and we're going to be looking at some specific examples of mutual funds and ETFs that Vanguard offers, and what I personally like, and what I invest in. So I hope you do enjoy this video, and let's get into it. So first of all, we're just going to look at what exactly is a mutual fund, and on Vanguard's website they have some info on that. So say investing in mutual funds offers benefits you won't get from trading individual stocks and bonds on your own. And one of the points is less risk through diversification. One mutual fund can invest in hundreds, sometimes thousands of individual securities at once. So if any one security does poorly, the others are there to help offset that risk. They also have lower costs, and they say with a no-load mutual fund, you pay one hopefully low expense ratio instead of racking up the commissions you pay when buying and selling individual securities yourself. They have a professional management, which means you don't have to keep track of every security your mutual fund owns. The fund is managed by experts who take care of that for you. And it's convenient because you can buy and sell mutual fund shares online or by phone and set up automatic investments and withdrawals. So this sounds pretty great to me. The one part that, at first, if I was new to this, it might be a little concerning to me is the professional management, because that sounds expensive. But with the index funds and mutual funds and ETFs I'm going to be talking about, they just sort of track the index, so there's not much management or research that the managers have to do. It's more just buying and selling when they're supposed to based on the index itself. And so as a result, these type of mutual funds generally have very low fees, especially with Vanguard. And Vanguard, historically their index funds have the lowest fees out there, generally speaking. So we're also going to look at what an ETF is. So they say here that investing in ETFs combines the diversification of mutual funds with lower investment minimums and real-time pricing. So the one thing with mutual funds is, first of all, they sometimes have minimums because mutual funds are specific to whatever brokerage you are investing with. So be that Vanguard or Fidelity or Charles Schwab, those mutual funds are specific to that brokerage. So you couldn't invest in a Vanguard mutual fund if you use Fidelity as your brokerage, where with an ETF you can invest in it with any brokerage, and it's just kind of managed by Vanguard, but you could still invest in it with any brokerage. And as a result, there's real-time pricing, and it's sort of traded live. So in ETF, the price will fluctuate throughout the day, and with a mutual fund, the price will change, but the changes really only go into effect per se at the end of the day. So you can really only buy and sell the mutual fund at the end of the day. You can submit your order anytime throughout the day, but it really only executes at the end of the day. And sometimes mutual funds also have investment minimums, which ETFs would not have a minimum. It would just be, whatever the share price of that ETF is. So we're going to define an ETF. It's ET is exchange traded, which means they're traded on major stock exchanges like the New York Stock Exchange and NASDAQ. And if you've ever traded an individual stock, then buying and selling an ETF will feel familiar because it's traded the same way. And F stands for fund, because an ETF is a collection of tens, hundreds, or thousands of stocks or bonds in a single fund. And it's similar to a mutual fund because owning an ETF will feel familiar because it has the same built-in diversification and low costs. So why invest in an ETF? It has less risk because it already contains a pre-selected collection of stocks or bonds. If a single stock or bond in the collection is performing poorly, there's a good chance that another is performing well, which helps minimize your losses, similar to a mutual fund. And there's also less work because you are basically leaving the work to a professional, which I mentioned before can sound scary because you might have to pay them expenses. But as we're going to look at, generally, at least with Vanguard funds and index funds, those expenses are pretty low and pretty minimal. So the first mutual fund we're going to look at with Vanguard is called the Vanguard Total Stock Market Index Fund, and the ticker is VTSAX. And basically what this does, it is designed to provide investors with exposure to the entire U.S. equity market, including small, mid, and large cap growth and value stocks. The fund's key attributes are its low cost, broad diversification, and the potential for tax efficiency. Investors looking for a low-cost way to gain broad exposure to the U.S. stock market, who are willing to accept the volatility that comes with stock market investing, may wish to consider this fund as either a core equity holding or your only domestic stock fund. So basically, this fund invests in every single publicly traded company in the US based on market value. So, the companies that are worth more money, they're going to invest more into, and the companies that are worth less, they're going to invest less into. So the key attributes we're going to look at: expense ratio. Basically what this means is what percentage of your investment you have to pay as a fee every year. So if you invest $1,000 in this, since the expense ratio is 0.04%, when you invest $1,000, you're going to pay 40 cents of expenses. And if you invested $100, you would pay 4 cents of expenses every year. And also the minimum investment is important. With VTSAX, it's $3,000. So that is, something to consider if you're going to use the mutual fund. But as it points out right here, it's also available as an ETF. And you can click on that and it says it's available as an ETF right here as well. So you can click on that. And when you click on that, you'll get loaded to this page, which is VTI, which is the Vanguard Total Stock Market ETF. And essentially, it's the exact same thing, except it's an ETF instead of a mutual fund, which means that it's traded, live on the stock market, and you can buy and sell it at any time, when the stock market is open, and you just have to pay whatever the price of that share is. So it seeks to track the performance of the CRSP US Total Market Index. So essentially, it's the same exact thing as VTSX, except it's an ETF. And actually, the expense ratio is a tad lower at 0.03%. So that's only 3 cents of expenses per year per every $100 you invest, which is even better. And then the next mutual fund that we're going to look at that I invest in is the Vanguard 500 Index Fund, VFIAX, and it is also available as an ETF as well. So it says that the 500 Index Fund is a low-cost way to gain diversified exposure to the U.S. equity market. The fund offers exposure to 500 of the largest U.S. companies, which span many different industries and account for about 3/4 of the U.S. stock market's value. The key risk for the fund is the volatility that comes with its full exposure to the stock market. Because the 500 Index Fund is broadly diversified within the large capitalization market, it may be considered a core equity holding in a portfolio. So essentially, this mutual fund is very similar to VTSAX, except instead of investing in all of the companies in the US stock market, it invests in about 75% of the largest companies in the US stock market. And it pretty much works the same way, has an expense ratio of 0.04%, so 4 cents for every $100 you invest, and then a minimum investment of $3,000 as well. And it is also available as an ETF, and that ETF is VOO, which is the Vanguard S&P 500 ETF. And it's pretty much the same thing. It talks about it here, but it pretty much just says the same thing. And the expense ratio, again, is 0.03%. So for some reason, it seems that the expense ratios, at least in these two cases on the ETFs, are slightly lower. So they might be a little bit of a better option. And also, we can look at the market price right now of the ETF because, as it said, that's basically the minimum amount to invest if you don't have fractional shares available with your brokerage. So for VOO, which is the S&P 500 ETF, it's about $396 per share. So you need about $396 to invest in this at a minimum. And then in VTI, currently it's around $222 per share, which is what you would need to invest in VTI. So that is a heck of a lot less than $3,000. So that could be a good option, if you don't have as much money to invest. And then we're also going to take a look here at the, dividend returns calculator just to show, that they're kind of the same exact thing. So if we look at VOO versus VFIAX, basically since 2012, which is when I think VOO came into existence, you can see that the returns are very similar. And the main reason that they are different here is probably because of that slightly different expense ratio. So 38,628 versus $37,813 as an ending balance when you started with $10,000 in 2012. And then if we look here at the other ones, VTI and then VTSAX, if we look at those, then we can also see they're very similar. 57,000 versus 54,000, so pretty close since 2001. And I would say the main reason for that is just that expense ratio is just a tad bit lower with VTI. So I think, for me at least, VTI and VOO and the ETFs definitely seem a little bit better because generally they seem to have lower expense ratios, and they generally, have a lower minimum investment because they really have no minimum investment. It's just, however expensive that ETF is priced on the market. So let me know what you guys think of ETFs and mutual funds. I definitely enjoy them, and invest a fair bit of my capital in them, just because it allows me to, invest a lot of money in solid companies that I, have faith in that will do well, and I believe in the US economy. So that's why I know, invest in these funds. But at the same time, I really don't have to put that much effort into it at all. And the expense ratio is just so minimal that I don't think it's really that big of a deal. I think, some ETFs and mutual funds are a lot more actively managed than the two I went over today. And sometimes those expense ratios can get a bit higher and can really start eating into your returns there. But with those super low expense ratios of 0.03 and 0.04%, I don't think it's really that much to worry about. So I recently actually made a video on what I think are the top 3 ETFs, so I'll leave a link to that right up here if you guys want to check that out, and I will see you guys in the next one.